very important banking sector conversation with Ayode Jiebo, who is the Managing Director and Chief Executive Officer at Afrinvest Securities. Let's continue that. Yesterday, we saw a bit of a sell-off, and I'm sure you see the numbers perhaps faster than I do on a daily basis. This looks a very bit like there was what you call a knee-jerk reaction.
Yes, what we, based on initial, is always expected in the market before you do your proper analysis. For some investors that have bought into some of these stocks 2-3 months ago, and they are still in the money. So you want to at least cap in terms of exit now and book some profits.
So some of them jumped the boat yesterday into the waters.
Exactly. But something interesting that we also observe is there was still a lot of interest for First Bank.
Buying interest.
Yes, buying interest. For First Bank holdings yesterday, I think we saw over about 110 million units in terms of transactions.
115.5.
Yes, transactions. So as we saw, people were trying to book profits, book income. There were also some that saw opportunities that within the medium to long term, let me buy into this stock. This is an opportunity. I've been waiting. I could not come in at 14. I could not come in at 12. Now it's below 11 or around 11. Let me just acquire this stock and wait. If I believe in terms of their future performance,
fundamentals,
future performance, then let me buy and hold now.
Because essentially, you're buying into the future. That's what equities is all about.
Exactly.
It's not like gold.
Yes.
You're just buying into what you think the future value will really be. So it's about looking forward.
Yes, it's about looking forward.
So you think some folks are there sitting with some money, waiting for stock prices to come down, and they are buying. I wish I have such money and time.
Yes, it's, you know, the market, there are sometimes we say when you miss that cycle, they rally. So when you feel that prices in terms of you are unable to join the upward cycle, then sometimes you want to wait. And for some of them that have been on the sideline, they saw yesterday was an opportunity. For those that feel that they've been holding, some people will have a target that, okay, First Bank will get to 15, 20 naira, and they bought maybe at 5 naira, for instance. So seeing it coming down from the 14 levels, coming down to the 12 levels, say I can still book some profit at this level. Or I can just, out of my current position, let me just reduce and book some and sell down. We saw that in a lot of also tier 2 banks yesterday.
Yeah, that's quite heavy with FCMB, Diamond, Fidelity. Yeah.
Yes, and when you see, for instance, Fidelity, in terms of historical dividend payment, payout ratio is around 50%. As I think last year has one of the highest dividend yield in terms of when you look at the analysis of what was paid out. So, and when you look at fundamentals too, in terms of the strategy the company is putting forward, for instance, even a Wema Bank with its with its alert mobile to acquire, to penetrate even using internet penetration, penetrating even the 60% of those that are unbanked in Nigeria. So there are a lot of interesting things that are happening within the banking space. For some of them are coming from a very low base effect. When you check what has happened in the last 2 years, the economy was really down. They've booked significant impairment charges. And with the improvement we are seeing in the economy, for some of those loans that ab initio were not performing, they booked significant provision. There's been a lot of provisions or impairment charges on. Some of them have been restructured. So we are positive in terms of our expectation, though for the area where for most of the banks last year, most of them enjoyed the high yield environment within the treasury because of high treasury bills rates. This year, it's not that interesting as last year. But you also want to look at it. Last year, they were not comfortable, at least from first quarter, first half, they were not comfortable to advance loans because for most businesses, we're still struggling accessing FX and stuff like that. But with what has happened with the stability within the FX market, improvement in the economy, for some of the banks would begin to just review in terms of their loan policy, especially understanding the particular market they want to play, because that's one major thing that we feel most of the bank also needs to do. So, identify your niche, understand how the market plays, understand the cash flow of that market, understand the risk and the opportunities in that market before you lend to the particular market. You may not have expertise in several sectors, but we should be able to know that this bank to this particular sector, just go there, they have expertise that will be able to analyze analyze that sector before
Simply put, don't be a jack of all trades.
Exactly.
Exactly. That's just simple. Don't be a jack of all trades and master of none. But again, let's look at the future of the Nigerian banks. How do you think the directors, the board of directors of all banks, including those that are solid, whatever, will be reacting to this?
Yes, I think for them, it has also helped them as a policy for them to have enough capital to reinvest. That's for most of the directors.
Do you think they will be revising their dividend payout policies? Do you think that will be part of the board meetings going on right now?
Yeah, for some of them that have been within a particular threshold, and based on our analysis, for most banks that have above 50% already fall within those that don't have limits. So you don't need to review your dividend payout policy.
And it's time for those who are without limits to oppress those who are within.
We take opportunity
this is
in the
time.
market.
This is time to oppress.
If I see, it's also an opportunity for me, for someone that don't believe, because this bank will not be paying dividend, I can acquire the stock now, and if I'm willing to wait it out, maybe for next 6 months, 12 months, and we see an improvement in terms of financial performance. And
hold on a second. You're telling me what the opportunities are, yes, even if one or two banks fall within this directive of no dividend?
Yes, there's also opportunity to acquire. So what you look for most of the banks, the NPL, what the NPL does is it drags down your bottom line, which is your profit. So because you have high impairment charges, your profit has reduced, and we're saying the little one that you're able to keep, don't pay it as a dividend. If they're able to restructure their loan, able to improve in terms of risk management, then the top line that's been performing, when you check their gross earnings in terms of how they earn income, if you see that they've been sustainable, or there's been growth within that space, then you are sure that if they're able to watch the non-performing loan, at the end of the day, you see significant jump in their bottom line.
And perhaps in their share price as well.
Yes, and that translates, once you see the improvement in the EPS, it translates to improved dividend payment.
So it's a double-edged sword.
Yes.
Very interesting. Very brilliant. Yes, there could be something in there. But let's take us through your report of the Afrinvest banking report for 2018. Does this directive, the directive from the central bank, does it look like something taken out of that report? Did your report indicate the worrying, the level of concerns we should have for the NPL and the CAR of the Nigeria's commercial banks?
Yes, interesting. The report, we try to highlight some of the sectors that the banks were really exposed. And a way to just tie that up rather than look at it per sector is that on a cumulative basis, if you know that your non-performing loan is at this level, I need you to have enough shock absorber to be able to absorb if perhaps you can't recover this loan at the end of the day. You have enough reserve that you can write against the non-performing loan. So this is also a wake-up call for most of the banks, that most investors will now be after checking your non-performing loan. How is it doing? Is it bridging the CBN rule? So once they begin to see that it's getting above the 5%, that sends a signal that this bank may not be able to pay as much dividend as I'm anticipating. And also for the directors, they would just try to also strengthen their risk management process. And at the end of the day, it would dovetail positively to their bottom line.
So you think the next annual shareholders meetings will be more focused on these two subject matters, the capital adequacy ratio and non-performing loans?
Yes, I think investors, it's high time they began to look at those other areas because rather than just get carried away in terms of the dividend payment that you get and dividend payment that you receive on annually, also the strength of that bank is also very key. So it should also be a topic for discussion in terms of what I know at the beginning of the year, most of the director or the board would give like a target NPL that they want to achieve for that particular year, a target in terms of the profit or margins that they want to achieve for that particular year, and also their capital adequacy ratio. Yeah, we expect, part of what we expect to see this year is that with the confidence we're seeing in the equities market, for some of the banks that have been raising capital via Eurobond as Tier 2 capital, they need to come and also take advantage of this opportunity, either via rights issue. We've not seen any bank in the last 4 or 5 years raise right, either come out to raise equity capital, either via rights issue or PO, so that they can strengthen their Tier 1 capital. And okay, we saw Union Bank, Union Bank raised last year, but we need to see more banks coming to raise more equity capital to strengthen their required or statutory capital.
In terms of risk assessment for commercial banks, of course, this directive, as we all said, has nothing to do with liquidity ratio. But then, if your capital adequacy ratio and your non-performing loans are beginning to weigh heavily on you, then your liquidity ratio, then just might be a very soft knock on the door of your liquidity somehow.
May not directly, may not necessarily lead to affecting your liquidity ratio in terms of meeting up with your obligation. And that's why when you check, you do like a deposit and maturity analysis of most of the banks, you discover that even the best bank, the top banks, have like maturity, deposit maturity ratio about 80% of their funds will mature within 60 days. But because you know of the velocity in terms of the activity that happens, once there's no run, you are able to manage that liquidity. Most people are not expected to take out their fund from the bank. So what most people will also be looking at is the asset liability management of banks. So you get your deposits. If it's the average maturity is 6 months, then when you also check in terms of your asset, what's the average duration of some of the loans that you have also given out. You also sent a signal in terms of how you meet your obligation. And that's why also they have a window that the CBN has also provided, that perhaps you have short-term needs. The discount CBN window is there for you to at least take in short-term funds, pending when maybe your liquid asset you can also sell off to be able to meet your obligation. So in terms of the risk management of the bank, I think for us, I think it's above average, but we still need to do a lot within that space.
What do you think the central bank, and this is taking us all the way back to the beginning of the conversation about the financial system stability. Perhaps this is some measure of stress test?
Yeah, it's like precaution. And most times we've always said that maybe the CBN is reactive, but this one is, they are being proactive, trying to, maybe a lot of the banks would have been submitting their full year result to them for approval.
For 2017?
Yes, so we depending on what has been proposed, maybe that's part of what might have informed this, notifying the market again that this policy was released in 2014, and now trying to narrow it down such that if I allow you to pay this dividend out at this time, it may affect your capital adequacy.
So the central bank. So the central bank. None of the banks have released their 2017 numbers. And just a week or two before that,
yes,
the central bank flagged off this,
yes,
right?
This is just to remind you that this policy
meaning
exists.
The regulator, the central bank, have seen the numbers.
It's not impossible. For some of the
yes,
banks, it's been announced that they've submitted to the
central bank.
Yes.
Bank so looking at those numbers, the regulator must have said, hold on a second, we need to flag this quickly before the money starts going out.
Yeah, exactly. And also to maybe try and douse maybe some of the back and forth maybe within the, with the bank managers.
I got it. As to whether you can pay this or you can't pay that.
Yes.
So that's why the threshold of the CBN requirements on dividend payout ratio is very, very important. Ayodeji, thank you very much. We appreciate your coming here.
Thanks for having me.
For clearing this up very well. And a nice job with that table there about who gets a green, who gets a red, and who's gone orange, something like amber. There is all there. You may go online and check it out.